Whoa, before you start investing and go all in a company, let's slow down for a minute. Welcome to How To with Mia and Ziad, where we give you what you need to know to build your future. If you aren't already, hit that subscribe button and follow us on our other social media accounts. You can find them under the handle Gerber Kawasaki. You won't regret being informed. Every week we discuss topics within the stock market, investing, and personal finance. But then we were talking last week and we realized that we never really brought it back to the basics. So today we're going to be talking about stocks, bonds, mutual funds, ETFs, and REITs, what they are and why you would invest in them. Please remember that nothing that we talk about should be taken as personal advice. If you have questions about your specific situation, please ask your financial advisor.
That's right, we can't believe it either. With all the conversations we've been having about finances and investments, we figured it's time to really dive into the actual investments that you are making. We wanted to take this episode to talk over the basics of stocks, bonds, mutual funds, REITs, all these different vehicles that you can be using to make sure that you're building your wealth. Let's get into it.
So let's get started. What even is a stock? Stocks represent partial ownership in a company. You buy stock in Tesla, you're part owner in Tesla. You buy stock in Apple, you're part owner in Apple. It's kind of cool. When you're buying these company shares, you want the price and the value of the company to increase, which is also known as capital appreciation. We definitely appreciate when the price goes up because that means that you are making money. If a share of a stock costs you $60 and now it's at $100, means that you made $40 in capital appreciation. In addition to capital appreciation, many companies will pay dividends. Stock dividends are a company's way of giving you a little extra profit that they made. It's like a bonus thank you for owning shares in their company.
Now, what is a bond? Well, a bond is a loan to a government or a company. When you buy a bond, you're giving your money to that institution and you're getting guaranteed back two things. One, the initial investment you made, and two, interest on it. So why do bonds offer different interest rates? Well, it's all dependent on risk. If you're buying a bond from a safer institution, they don't have to offer as high of interest rates. While on the other end of the spectrum, if you're buying a bond from a risky company that could potentially go bankrupt, you need to make sure you're getting your money's worth as an investor. And so those kind of companies have to offer a higher interest in order to attract the amount of investments they're looking for. Now, there's a few different kinds of bonds that you can be buying. The two major types are government and corporate bonds. Government bonds offer lower interest rates because they're safer. Government can't really go bankrupt because they can always print more money or can tax more. While a company does offer a little higher interest because they have the potential to go bankrupt. So keep that in mind when you are deciding between the two. The last type of bond to keep in mind, especially if you're someone who's in a high tax bracket, is municipal bonds. Now, municipal bonds are government bonds, but rather than being on the national level, they're on the state and local level instead. And so the beauty of buying municipal bonds is any interest that you're collecting from this bond is going to come in tax-free on the federal level. And if you buy this bond within the state that you live in, you're also going to be collecting interest tax-free on the state level as well. So if you live in California and you buy a California municipal bond, then you're not going to pay any taxes on the interest that you're collecting. So keep that in mind when you do look into buying bonds.
So before we start comparing why to invest in stocks versus why to invest in bonds, it's important to talk about why to invest. At the very bare minimum, if you're not investing, you're volunteering to lose money. Inflation goes up each year, and if your money is not growing with it, it's becoming less valuable. Besides inflation, a reason for investing in stocks is for capital gains. The goal is not just to keep up with inflation, we want returns in excess of inflation. We want to put our money to work now so that we can reach those future financial goals of buying a new car, buying a house, having a family, and retiring hopefully one day. The younger you start, the better. Like I stated before, it creates additional income through dividends. Bonds, on the other hand, hold their own benefits. If a company goes bankrupt, the bonds and preferred stock are going to be paid out first. Bonds are thus less risky and they are typically more stable, but you're not going to get as high of long-term returns that you'll get with stocks. When I say more stable, I mean that the prices are not going to fluctuate as dramatically. It's good to have a mix of stocks and bonds to create a balanced and diversified portfolio. So not every stock is a buy. and not every stock goes up. Stocks don't only go up. Based on your goals, there are different types of companies that you should be looking into. But there's two popular approaches to investing. One is investing in growth companies, and two is investing in value companies. Growth companies are usually priced higher and have more risk associated with them because they're expected to grow a lot in the future. And that doesn't always happen, and there's often bumpy times along the way. And we like to call that volatility. They can go up and down often, more so than the overall market, which is not ideal for investors with a short time horizon. A value company is priced lower than other similar companies in its industry. It's a solid company that other investors have not caught on to yet. Instead of catching the wave as it's going, like you are with growth companies, you're there before it starts again. So these companies have usually fallen out of favor momentarily, but when they come back, you can experience some big gains. These are again ideal for long-term investors.
When you buy a mutual fund, you are pooling your money with thousands, if not millions of other investors and hiring a money manager to make investment decisions for you on a day-to-day basis. When you buy these funds, you're essentially buying a basket of investments all at once. And the beauty behind this is that you get to become instantly diversified. What diversification is just not putting all your eggs in one basket. This is essential when it comes to investing. You want to spread out your risk amongst a bunch of different investments so that way if one company does bad, there's a bunch of others that are going to help continue boosting the value of your portfolio. Now, you can buy funds geared towards different goals, whether it be high octane growth, producing income, wealth preservation, or even getting into certain areas of investments that you like. Now, because you are hiring this money manager, there is a cost attached to it in the form of expense ratios or fees. Those expense ratios or fees tend to be around 0.5 to 1% in fees. If you are seeing in the mid to high 1% in fees, you might want to take a look at your fund and make sure you're getting the proper return for your investment there.
ETFs are another form of pooled investments. And by pooled investment, I mean that there's a lot of investors that are pooling their money together and buying a bundle of multiple assets, whether these assets be stocks, bonds, commodities. ETFs trade exactly like other stocks and can be bought and sold throughout the day. They can also be purchased on margin or sold short, but we'll talk about that a little bit next episode, I think. ETFs are passively managed, so they're going to have lower expense ratios compared to a mutual fund. Expense ratios are like pay-as-you-go fees. So if you have a 2% annual expense ratio and you only hold your money in the fund for half a year, you'll pay 1% in fees.
Now imagine this, mutual funds, but for real estate. Well, that's exactly what REITs are. REITs stand for real estate investment trusts. What they are is you pool your money with thousands, if not millions of other investors, and you're hiring someone to manage a real estate portfolio for you. There's two major kinds of REITs that you can purchase. The first is equity REITs and the other is mortgage REITs. Equity REITs are funds that actually own the real estate property and are renting it out and collecting rental income. While mortgage REITs just simply lend to other real estate borrowers. They make their money from interest on the mortgage payments that are coming in. Now, REITs are a more income generating asset. You don't want to think about them for high octane growth, but they're a great way to get into real estate and diversify your assets while not having to actually purchase and manage a real estate property of your own. Now, you understand what these types of investments are, but how do they apply to your situation? Well, that's exactly what we're here to help with. We're here to sit down, talk through what you're trying to accomplish with your finances, and create a portfolio allocation of stocks, bonds, funds, REITs, and much more that fit your needs. So, what are you waiting for? Reach out to us. We're happy to sit down for a consultation and build that plan.
Again, we are so happy to be here, helping you get invested. Please, 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 please don't be afraid to ask us any questions. We're here for you. Also, give us any suggestions of topics that you want to hear about. We're learning and growing our money together. If you want to reach out to us directly, please call us at 310-441-9393. Of course, hit that subscribe button and follow us on our other social media channels, Gerber, Kawasaki for all of them, and you can DM us directly on there as well. And we will hopefully see you next week. Happy investing.
See y'all next week.